Welcome back to the channel where I make it my goal to share my passion for passive income and dividends while also keeping it as simple as possible. If you're looking for a great way to generate passive income that could either supplement your income or replace it completely, look no further than dividend investing.
A dividend?
Money.
In this video, I'm going to outline the 10 essential rules to follow if you want to be a successful dividend investor. Get ready to learn a thing or 10 and let's jump into this week's video. Kicking things off with rule number 1, which is to have a plan. As with most things in life, having a plan is essential to success and dividend investing is no different. Questions you could ask yourself to guide this plan could be, do you plan to completely live off of this generated income or just use it to supplement your retirement lifestyle? How long until you need the generated income from this account? What kind of metrics do you understand and filter your stocks by? And how much money can you add to your investment account and how often? Again, these are just some questions you could ask yourself when creating a plan to make sure you understand what you hope to get out of this style of investing and make sure you're on the right track. Rule number 2 is going to be to respect the payout ratio. Understanding this simple metric is very important when creating a growing and hopefully self-sustaining dividend portfolio. Simply put, the payout ratio is how much of a company's earnings are paid out to its shareholders in the form of a dividend. A lower payout ratio shows that the company is still focused on the growth of the underlying business and has plenty of room for future dividend increases and payments for years to come. While a higher payout ratio tends to show the opposite, a company that is not focused as much on the growth of the company and could be hard pressed to offer respectable dividend increases or keep the dividend going at the current pace for much longer. Rule number 3 is to diversify for safety. Diversification is key to mitigating risk even in dividend investing. This can be achieved by investing in different stocks in different sectors with different market caps and even holding in different regions of the country. Dividend paying ETFs are a great and mostly hands-free way to invest into tens or hundreds of different companies in one bucket versus picking them out on your own. Of course, you can also pick your own individual stocks if you want more of that hands-on approach without the worry of expense ratios. Rule number 4 is don't chase dividend yields. Yield chasing, or the practice of choosing dividend stocks based solely on their high yields, is one of the most common mistakes that new and even experienced dividend investors make. However, higher dividend yields often come with increased risk, both in terms of the stock price appreciation or lack thereof and the dividend being cut or even eliminated. This is where it's extremely important to remember the first 2 rules of the video: have a plan and respect the payout ratio. Because when choosing stocks, it's crucial to look at more than just the yield offered by the company. While the dividend yield can certainly be a factor in your decision-making process, it should not be the sole determining factor. Additionally, investors should be cautious of stocks that have unsustainably high yields, as this may be a sign of trouble ahead. Instead, focus on stocks with proven track records of consistent dividend growth and solid financial position. Remember, the goal of dividend investing is to generate consistent and reliable income over the long term. Don't sacrifice long-term success for short-term gain by chasing yield. Rule number 5 is reinvesting dividends is very important. Reinvesting your dividend income is a key strategy for building long-term wealth through dividend investing. By automatically reinvesting your dividends, you can take advantage of compounding returns over time. For example, let's say you invested $10,000 into a dividend stock with a 3% yield. After 1 year, you would have earned $300 in dividends. If you reinvested those dividends back into the same stock, your new investment would be worth $10,300. And the following year, you would have earned $309 in dividends. If you continued to reinvest your dividends every year, your investment would grow significantly over time. In fact, according to a study by Hartford Funds, reinvesting dividends can account for more than 60% of the total return of the S&P 500 over the past 40 years. Right here is a cool chart to show the growth of a single $100 bill since 1980 with dividends reinvested and without. You can see that with the dividends being reinvested, that $100 is now worth more than $5,000 versus the less than $2,000 if you didn't reinvest the dividends. Rule number 6 is dividend streaks matter. Companies that consistently pay and increase their dividends year after year can be a great indicator of financial stability and commitment to its shareholders. There are several lists of dividend stocks that use dividend streaks as one of their main criteria, such as the dividend kings and aristocrats and the champions, contenders, and challengers. Investing in companies with long dividend streaks can provide a sense of security, as these companies have weathered economic downturns and market fluctuations while still maintaining and increasing their dividend payments. This shouldn't be the only factor factor when considering a dividend stock, but can be a simple and useful tool to identify strong companies. Rule number 7 is to understand the tax implications. While it's next to impossible to avoid taxes altogether, dividend investing can be a great way to keep more of your money. Looking here, you can see the top chart being the qualified dividend tax rates, while the bottom chart has the non-qualified dividend tax rates, aka the normal tax brackets for 2023. For example, if you were to make $400,000 in income or non-qualified dividends as a single filer, you would be at the 35% tax bracket. But if you made that same $400,000 in qualified dividends, you would only have to give away 15% in taxes. Even better, holding dividend paying stocks in tax advantaged accounts such as IRAs, HSAs, and 401ks can further shelter your money from taxes. Rule number 8 is to keep your emotions in check. Emotions can be a significant hindrance to successful investing, including dividend investing. It's easy to get caught up in the excitement of buying a stock that's performing well or the fear of selling a stock that's dropping in price. However, making investment decisions based on emotions can lead to costly mistakes. For example, during a market downturn or times of uncertainty, it can be tempting to sell your dividend stocks to avoid further losses. However, selling during these times can mean missing out on potential long-term gains when the market eventually recovers. Similarly, holding onto a stock that's not performing well because you don't want to admit a mistake can also be detrimental. It's important to be objective and evaluate each stock based on its fundamentals and future potential rather than getting too attached to any particular investment. To keep your emotions in check, it can be helpful to refer back to rule number 1 and establish clear investment goals, have a solid plan, and stick to your strategy. By focusing on your long-term objectives rather than short-term market fluctuations, you can avoid making hasty, emotion-driven decisions that can hurt your portfolio in the long run. Rule number 9 is to consider dividend growth rates. The dividend growth rate refers to the rate at which a company increases their dividend payouts over a certain period of time. As long as the dividend increases are supported by the earnings and the payout ratio, companies that increase their dividends at rapid paces can lead to very fast compounding over time. For example, if you invest into a company that pays $1 per share per year that increases their dividend by 8% year over year, after 10 years, that same company's dividend would now be $2.16 per share per year, which more than doubles your dividend income from the same company without the addition of any funds from you over that time. Also, it might be a smart idea to look for companies with dividend growth rates that outpace inflation, as this can help protect the purchasing power of your dividends over time. Rule number 10, focus on total returns. It's important to remember that while dividends are obviously a key component of dividend investing, they are not the only factor that determines your total returns. Stock price appreciation is equally important and can significantly impact your overall performance. As an example, imagine investing in a stock that pays a high dividend yield but has declined in stock price. The dividend income may be attractive, but the overall total return of the investment may be negative. Therefore, it's important to focus on total returns, which include both dividend income and stock price appreciation. This approach allows for a more holistic assessment of an investment's performance and can lead to more successful outcomes. So remember to keep an eye on dividend yield and stock price movements when evaluating a potential dividend investment, and focus on the total returns to achieve your investment goals. And with that, you've now made it through the 10 rules of dividend investing. By following these rules, you'll be well on your way to a successful dividend journey. Please be sure to leave a like on the video and share it with others that might find it helpful. And don't forget to subscribe and ring the bell so you don't miss any of my other dividend related content. If you're new to dividends and want to know more about all the different metrics and terms, make sure you check out this video. But until next time, see ya.